Welcome to Money Market, a Bank of Tampa podcast. We highlight the businesses, expert business advice, the local economy, and points of interest in the Tampa Bay market. Follow us on Spotify, Apple, YouTube, or wherever you find your favorite podcasts. And please share this episode with a friend or colleague. I'm your host, Owen LaFave, the Pinellas County Market President for the Bank of Tampa, Tampa's oldest and largest community bank. Today, our very special guest is Shaun McClung, who is the Managing Director of CBIZ, a national accounting, tax services, insurance, and HR consulting firm. And I believe the 11th biggest accounting firm in the U.S. Is that
is true. Yeah, we're always trying to be in that top 10, and then we get to the 11th, and we're 10th.
And you get bumped out?
Yeah, that's right. It's a constant
So the
battle.
goal is to get back into 10?
That's it.
So
Something
you're
about being 10th, you know?
But so you're a certified public accountant, so CPA,
Yes,
providing tax consulting and compliance services to both privately held and private equity owned clients in a variety of industries. Mm-hmm. So you've got extensive experience with a broad range of tax matters, including the IRS. It's everybody's favorite government organization. So
Yeah, growing every day.
But not the 87,000 that we thought we were going to have, right? That was vetoed. But experience with state examinations, accounting method changes, tax due diligence. So all things accounting, which is why we're here. You spent 3 years with Andersen in Philadelphia, mm-hmm. and 7 years with KPMG, and they are one of the top five, right?
Yeah, Big Four. Big Five with Andersen. Then Andersen is no more, so now it's Big Four.
Big Four.
Yeah.
All right. So your community involvements include your prior chair of the St. Pete Chamber of Commerce, the Finance Committee, which
That's
is
right.
also my old job. Bay Area Chamber of Commerce, Tampa Connection, Leadership Tampa, and among many others. But I like to point this out because I was also an up-and-comer. So you were an up-and-comer
yes.
in 2015. And I told Demetra Simmons this with the Tampa Bay Partnership. No one tells you made it. They just tell you you're an up-and-comer, but no one pulls you aside and says, attaboy, Shaun.
Yeah, that's right.
I'm telling you made it.
Yeah.
So
I'm going to tell my wife that. She'll be very proud.
tell your kids you're...
Yeah, that's right.
So my first question is, why did you want to be an accountant?
That's a good question. I actually, a finance major, was wanting to get into investment banking perhaps, but kind of stumbled into accounting and got really intrigued with tax and tax consulting and the opportunity that provides to help businesses and their owners save money, quite frankly. And you can kind of see the benefit. You meet with these owners, and after they have some significant transaction, just the appreciation, the satisfaction you get from helping folks. And tax laws are constantly changing. So as someone that likes to be challenged, that's an opportunity to constantly stay challenged. Now, sometimes it changes more than I'd like because I'd like every couple of years is fine, not every year.
But it keeps you employed, right?
Yeah, as we went through the pandemic, there was just new tax laws, credits, et cetera, every single year. Mm-hmm. Constantly learning, not a lot of detail behind those changes when they first came out. So some guessing games as we wait for the IRS to kind of catch up with regulations. But yeah, you're right. Keeps us employed. Good opportunity to kind of help those businesses and owners save money.
So it wasn't the green accountant hat, the visor?
The green accountant hat is
that wasn't the allure?
It was a benefit. Yeah, an unknown benefit when I went into it.
Do you have one?
I don't have one.
Well, you do now.
Yeah.
Because
attaboy.
And I know some people are just listening to this, but I brought you your official accountant green visor.
Thank you, sir. So, yeah.
And I am bequeathing that to you. I'm passing it on now that I'm no longer the finance chair for the chamber.
It'll be a hit back in the office today.
So here's the other question that I have to ask this on behalf of all bankers. So is there a trade association that's American Accountants? What's the major trade group or association?
The AICPA.
AICPA.
Yep.
Okay. The American Institute of Certified Financial Public Accountants.
That's right.
Okay. I need you to carry the torch on this one for all bankers.
Okay.
Why are the K-1s prepared separately? Why can't we get those as part of we have to ask for them after the fact. We get the tax return and then we have to go back to you and say, can we get the K-1 schedules? And for those that don't know, a K-1 for business owners, for pass-through identity entities, for S corporations and partnership, it is a separate statement that's prepared that as bankers we need to do a cash flow, and we always have to ask separately.
Well, it is included as part of the partnership or S corp return, but if you're getting the individual's return, then yes, you got to get that separately, unless you ask for the full partnership return. And in that case, there's other partners in that return as well, so they're not wanting to give you the information for all partners, just the one you're probably working with, if I had to guess.
Okay. Well, it's a hassle. I'm just letting you know.
Yeah, all right. Gives us more opportunities to interact with each other, Owen. I appreciate that.
And I enjoy interacting with you, Shaun,
Yeah.
so I appreciate that.
Yeah.
Tax season is upon us.
Yes, it is.
So can you share some tax prep tips for our listeners?
Yeah, really gathering all your information as it comes in, finding a way to collect it and be organized, right? That's easier said than done. Our clients that are most organized get their returns completed the quickest, and they get their refunds the quickest. To the extent that we are having to kind of chase and follow up with information, it can drag out a tax return till October. And then we're asking questions in October.
Or this year till February.
That's correct. And then we're asking questions about a year prior, and memories obviously get faded over time. So it becomes a little more challenging to get that done.
And so be proactive throughout the year.
Proactive, exactly. And to the extent you have things happening, major occurrences in your business or your personal investments, getting in front of your tax advisors at that time, letting them advise you real time rather than trying to, we'll say, fix things after the fact. That can be a challenge and sometimes just not possible.
Okay. In terms of people taking advantage, so we had a couple storms last year here in Florida.
That's right.
So which enabled the tax returns to be extended until February, which it felt like the entire bank customer base took advantage of that.
Yes.
Is that just our small segment, or did a lot of people do the same?
I'd say it is those that would have otherwise filed right at October 15th instead filed at February 15th.
Okay.
Those that procrastinate. So not uncommon in the tax world or the banking world or in life, quite frankly, right? So yeah, we had a fair number of those.
The system enabled the procrastinators to procrastinate.
That's right, and we actually thought we'd get more returns done between October and February, but no, they all got done in January and February.
Of course.
Yeah.
So we know what you were doing in January.
That's it. Yeah.
But so in terms of tax planning ideas coming up, so there's various things like cost segregation studies, LIFO for taxpayers with inventory. Mm-hmm. Can you go over some of those things? Certainly.
So anyone that buys a building or builds a building should certainly do a cost segregation study. It's an opportunity to accelerate the recovery of your expenses. So for example, if you don't do that, the cost could be recaptured over a 39-year period. And if you do a cost seg, you could get those costs recovered in the year of your expenditure, or 5 year, 7 year, 15. So there can be a pretty significant present value of cash savings there.
And for those that don't know what that is, can you explain that for listeners?
Yeah, it's essentially an engineer going into a building and identifying what property within that building, which components of the building can be classified as a shorter life for tax purposes. So instead of just looking at the building as a whole, they segment it into floors and electrical, fixtures, cabinetry, etc. And so we can classify into shorter lives, which allows us to kind of write those off quicker for tax purposes.
What's the cost of those typically? And so where is the breaking point in terms of, okay, you've got to pay for that to happen?
Yep, that's a great question. Yeah, the cost, I'd say around $15,000, likely, give or take, given on the size of the building. But generally, if you don't have a building that's more than $1 million in cost to build, then it doesn't really make sense. Yeah.
Okay. And that's new construction only?
No, if you buy an existing building, same story. They can go in and make a determination on an existing building on kind of how to segment those assets into shorter lives.
Okay. Now, does CBIZ do that, or? Yeah,
we have a group. Specialty group to do that.
Okay.
Because again, it's a kind of specialty practice. Takes certain engineers to go in. That group is located actually here in South Florida, but they work across the country.
Okay, good. LIFO for taxpayers with inventory. Let's talk about that.
Yeah. So this is a great
last in, first out. LIFO.
Last in, first out, as opposed to first in, first out. First in, first out is the standard.
GIBO. Garbage in, or GIGO?
Yeah, garbage in. Okay, yeah, I like that one too. LIFO is an important concept to remember when prices are going up. So if you think about last in, first out, that means you're electing to choose to sell or report that you've sold the newest inventory first, which means the highest cost inventory first. Mm-hmm. So essentially reducing your profit, reducing your taxable income by expensing the higher cost inventory first. So
Okay.
that's a bit of a complicated process. It sounds easy, but to elect that method, there is some calculations that need to be done to create inventory pools, et cetera. So we have a group that does that as well. Not every CPA will be adept at doing that. In fact, I lean on that group myself because it is a specialty area. But if you have more than $5 million of inventory, then that's something to consider.
Well, then, as an operator or business owner in that scenario, you probably have a pretty significant or substantial inventory management system, so you can track that. And in a high inflationary environment like we're in now, this is really an opportunity to take advantage of that, right? This
is something we're talking to with all our manufacturing clients currently, and we're trying to get in front of them. And people don't like change, and this is, certainly there's a cost to doing this, but there's also a tax savings, and we can provide a cost benefit analysis, just like on the cost segregation studies, to kind of show what that looks like and help inform the taxpayer if they want to make that change or not. But in this inflationary environment, this is kind of the number one thing to think about.
Seemed to be a good opportunity to take advantage of that.
That's it. Yep.
All right, QBI, Qualified Business Income Deduction.
Yeah, so that is a 20% deduction essentially for pass-through businesses. So if you have a partnership or S corporation and you are in most businesses, bankers, attorneys, accountants, businesses don't qualify for this deduction, unfortunately for us. But most businesses that are operating a business, manufacturer, retail, a lot of services businesses, it's a 20% deduction for qualified business income. So it essentially creates a benefit to be a pass-through business as opposed to being a C corporation.
Okay. Is that at risk of expiring at any point?
That is. 2025 is the last year that will be in play currently. There's part of the sunsetting provisions from the Tax Cuts and Jobs Act. Gosh, I guess that was back in 2017 that passed.
Okay.
So it's making pass-through businesses more beneficial today. After 2025, there's going to be discussion with a lot of clients. Is a C Corp better than an S Corp, better than a partnership? We had that discussion before this qualified business income deduction was in place, and we'll be going through those discussions again. Because the effective tax rate of both of them, both of those types of entity choices realign.
And we've experienced that from a client standpoint of them transferring the entities back and forth because of the change in taxes. And I guess we talk about the changes that keep you employed, and so let's talk about some of those. I mean, is there any potential tax legislation that could impact the 2023 tax returns?
Unfortunately, I'll say yes. There's some legislation out there very beneficial to taxpayers that was slotted to pass back before the end of the year, of course, and then in January, still hasn't done. The House has passed it. The Senate has not yet passed it. It was to bring back 100% bonus depreciation deduction. Currently, that sits at 80%. It was to allow for expensing of software development costs and other research and development costs. Those are now required to be capitalized and expensed over a 5-year period or a 15-year period, depending if it's domestic or foreign. And that was a big change. So any company that was doing research and development typically was expensing that immediately. To then have to put that back up on the balance sheet, increased net income, and that was new last year.
So was that, net, is it a disincentive then to...
That's certainly the argument.
Yeah,
the argument is that it's a disincentive to spend that money. It's a longer time to recoup your cost. And so we want to encourage U.S. businesses to do research and development and to do it in the U.S. And so that's the argument to bring that back. The other item, which
before you jump into that, when you do look at the historical impact of that, so we and where we've gone to, corporations, let's say, 15, 20 years ago, used to invest heavily in R&D.
Right.
And so they, over the years, have gotten away from that, and it's all cost-saving strategies, and so they're not investing. So it's unfortunate that's going away. But question I had about that, too, is we had a lot of clients, and maybe this is one of the unintended consequences, but that went out and bought high-income clients that bought airplanes because they could depreciate those quickly.
Yep.
Gas stations became very popular because all the equipment, they could depreciate those quickly. I'm trying to think of maybe what else, large equipment purchases that maybe accelerated the purchasing timetable.
Right.
Those weren't necessarily intended as part of that change in legislation, but certainly benefited from it.
Right.
So conceivably right now, all that's going away too.
Yeah, bonus depreciation, 100% last year, 80% this year, and then it goes 60, 40, 20 until there is no more bonus depreciation. Now, that doesn't mean you lose your ability to cost recovery.
Yeah.
That's right. You just spread it over the life of the asset, which again is 5, 7, 15, 39 years. So the benefit of the incentive to buy equipment today, it's a harder decision for those business owners because they don't get to expense it right away.
Got it. So what about the treatment of interest expense?
This is a big one for you because interest expense is limited. It has been since the start of Tax Cuts and Jobs Act. Previously, it was limited to 30% of EBITDA, right? Earnings before interest, taxes, depreciation, and amortization, which a lot of our clients, that was okay. Once they added back depreciation and amortization, they were able to deduct their interest. Last year that changed, so no longer could you add back depreciation and amortization. So that ended up limiting a number of our clients that were leveraged. So those that were acquisitive and using debt to grow their business now had pretty significant interest limitations. Now that interest isn't lost, it's deferred, but in the year it's limited, you could have gone from a book loss, maybe a significant book loss, to a taxable income position, and that was a surprising one for most clients. They knew that was coming. We'd warned them about that, but when you actually see it in place and you're reporting taxable income when you think you're going to have a pretty good book loss.
And you mentioned for us too. I mean, surprise for the clients, but then they're handing us their financial statements, and we're like, "What happened?"
Right? Yeah. Right. You have a book loss. Why are you paying tax?
Right.
And it disincentivizes taking out debt to grow. Right. So our clients are generally growth focused. Right. Grow or die, and oftentimes using debt to do that. Even private equity owned businesses that have certainly large cash infusions, initially they still use debt to grow. So this interest limitation is a limiting factor for sure on growth.
Any other legislation that's coming down the pike?
Well, the employer retention tax credit, as we know, that's been, if you haven't heard about that, you've been under a rock because it's been on the radio, it's been on TV, it's been everywhere.
It $7,000 per employee per quarter, up to like $28,000 a year.
That's right. For 2021, a little less for the 2020 tax year.
Okay.
The IRS had realized and decided there's a lot of fraud out there, and when a tax benefit becomes highly advertised, then you realize there probably is going to be some fraud there, right?
Yeah.
The IRS actually put out a moratorium to stop processing new claims back in September of 2023.
Okay.
That didn't mean you couldn't make a claim. It just meant they weren't going to process it because they were concerned about fraud. They wanted to kind of beef up their review of the claims that were coming in. This legislation that's passed the House, not the Senate, had set a cutoff date of January 31st for any new claims. Also hearing senators currently talking about kicking this law to next year because they're going to have to deal with all these other extenders that are sunsetting under the Tax Cuts and Jobs Act. So what we once thought was going to get passed by the end of the year now looks like maybe it won't get passed at all.
So something that has seemed to come up every year for the past, 4 years, carried interest.
Right.
So any potential legislation or changes there and how that's treated?
Well,
and maybe share everybody a little bit about what that is.
It's a way to pay the asset managers for generally private equity, venture funds, hedge funds. They are not the cash investors. They're the ones that are operating and running the fund, running the investment, growing it, helping to find an exit that provides value and return to the cash investors. So that carried interest is a share of the profits upon exit. And that share of the profits has historically been a capital gain. That's not liked by certain members of Congress because they feel they're providing services, much like you or I provide to our businesses. We get wages, we pay ordinary income, we pay self-employment tax, and the investment advisors are not paying those ordinary income taxes, self-employment taxes, et cetera. So they've worked to make it harder to get that capital gain. In the Tax Cuts and Jobs Act, that changed to a 3-year you had to hold it for 3 years before the investment before you could get capital gain. I don't see it going any further. I was pretty surprised that got passed, and that seems to have kind of settled the argument that the hedge funds that turn their investments pretty quickly, a year or so.
That seemed to be a fairly good compromise, because the other side of that is the value conceivably can fluctuate pretty dramatically year to year. So how are you taxed, substantially for a gain or perceived gain that you have one year, and the next year you have a loss? And how do you reconcile that? And people are writing checks and getting big refunds, and just the back and forth is, I can only imagine how messy that could be.
Yeah, the tracking is a challenge, and just another layer of reporting for tax returns. Tax return reporting has gotten a lot harder over the last several years. We are essentially becoming auditors in a way. The amount of disclosures and information the IRS requires us to
it's more job security, Shaun.
It is, but it's just a lot lot reporting. So
it's the AICPA. That's like we need
pushing
more.
And lobbying
we need
that.
More,
yeah, that's right.
Big accounting.
Yeah, more check boxes. It just doesn't make anything simple. So clients that think they have a simple tax return, there's unfortunately nothing simple, and it's a lot more training for our younger folks as we kind of get them fully engaged and ready to serve.
Maybe this is a good transition. We're talking about simplicity. So individuals' tax returns are obviously a little bit more simple, but something like a TurboTax.
Right.
If you're very simple, is it safe to say that's okay? But if you've got any complexity, stay away.
Yeah, I think very highly of TurboTax, and they have an interview process, right? So it's a well-designed software that will walk you through and ask you questions. Did you do this? Did you do that? And help you know what you need to report. So
okay. So beyond a W-2 employee.
Yeah, W-2.
So if you're a small business owner, still TurboTax is a good tool.
Yeah, it gets a little more challenging when you have a small business, because you may want to be thinking strategically about deductions, et cetera. But TurboTax will help you do the proper reporting. I think where it gets to that business advisor relationship, when you're starting to think about growing or investing in your business
strategy,
then you want someone to talk to. Obviously, they talk to you as the banker, because you've got other similar clients that you can kind of glean that experience. But that's often where we start adding value, as they're looking to grow, expand. And they need a little more than just kind of filling out the forms.
Yeah, so I often tell people when they ask about the Bank of Tampa, if you want a relationship, you want to know who your banker is, you want some advice, you want to share your business plans and help us kind of be the quarterback and put the deal team together to help you accomplish your business goals, then we're the bank for you. So
that's right.
Similar approach to accounting.
Exactly. We like to say that we are we serve businesses and their owners, and now that includes private equity more than ever, just given the market in Tampa in particular has been very attractive to private equity. So more and more exits have been happening from some historically privately owned businesses. But yeah, we're there to help advise, help through those exits.
And man, how things have changed. 10 years ago, we could not get private equity here. And
that's
now
right.
It's abundant, which is a great sign of, we're a growing economy. There's a lot of attractive businesses here. There's a lot of growth opportunities. So it's nice to attract that capital and, get some unicorns here too.
That's right. Yeah. There's been a lot of great business growth and exit stories here in the Tampa market, and I think the interest is still there. They're still finding great investments here.
So individuals, one of the things that seems to come up is energy efficient home improvements. Are there any tax incentives available there?
Yeah, so new law passed last year that helped with that. HVAC, solar's gotten very big. I have a number of clients that have kind of decided, okay, now's the time. The cost versus benefit on the energy saving side, plus when you layer on the Fed credits, then it starts to make sense. So a number of clients have done solar. There's EV credits that are out there now, not just for new vehicles, but for used vehicles. Now the law just changed there, right? Because there used to be a $7,500 credit. Is that still in place? Did they change the vehicles that can qualify for it? Yeah, they made it more complicated. Imagine that.
That's what they do.
Yeah, so there was
look at all this job security.
Yeah, that's right. I'm just constantly reading tax
big
law.
Accounting.
Yes. I sleep well at night because I read tax law on the way to bed, so it's very helpful. There was a change. Yes, there's still a $7,500 credit. There is an income limitation to that credit. So if you're buying a new vehicle and you have more than $300,000 of adjusted gross income as a married couple, you're not going to qualify for the credit. So, and there's rules on sourcing of the batteries, et cetera. Yeah, that's right. That's right. And then there's a used car credit that didn't exist before. So that was a new benefit that came in. That's only a $4,000 credit. The income limit is a little lower for that. I think it's $150,000 maybe or so. But that didn't exist before. But there is battery sourcing component now to that credit. So that's where the complexity came in.
Conflict minerals.
That's right. So you essentially have to go to the dealership and say, hey, does this car qualify? And what does it qualify? Full credit, half credit, et cetera. And they're required to tell you.
Okay. So what about other tax benefits that are sunsetting after 2025?
The big one that we're kind of talking to our clients and the attorneys we work with in the estate tax space are as well is the estate tax lifetime exemption. It's currently at about $13.6 million for a married couple. That's slotted to get cut in half after 2025. So to the extent you have a significant estate, you'll want to do that planning now. Mm-hmm. That's $13.5 per person.
Okay.
So a married couple, $27 million. And that's going to get cut in half at the end of 2025. So if you've got significant assets that you want to move into your kids or to a trust for your kids or any other family member for that matter, now's the time to do that, to set up the trust that you need to facilitate that. At the very least, you can make those transfers at the end of 25, but to do all the documentation is going to take time. Get on your attorney's calendar because they're filling up. Mm-hmm. And we've seen this in the past when these lifetime exemptions have changed and been threatened to decrease dramatically. This is one I'm not sure that will get extended, even if we get others. It's hard to predict anything. The exemption's been very high, and it's easy to let that lapse in the mind of a lot of folks because it's a small population that qualifies for this exemption.
Definitely less than the 1%. I don't know what the percentage is, but it's less than 1.
That's right. Now, the other items are individual tax rate. The highest rate is 37% currently. That goes back up to 39.6%. The standard deduction. So a lot of our clients were able to qualify for the standard deduction because it had gotten doubled. That's about set to get cut in half from about $28,000 down to $14,000 or so. So folks that weren't keeping their charity receipts anymore, time to start doing that again after 2025.
I'm terrible at doing that.
Yeah, well, you give to give.
Right.
It's not for the tax deduction.
Same.
Yeah. The investment investment expenses previously weren't deductible, so broker fees and that are back in play. And then that QBI deduction that we talked about sunsets as well.
That's expiring. Any other deductions that individuals should be aware of to take advantage of?
Yeah, I mean, it's truly charitable deductions is kind of the one that we see most common, right? And the focus there is on giving appreciated stock if you can, rather than cash. Because if you got appreciated stock, you avoid the tax on the capital gain on the appreciation, and you get the deduction for fair market value. So you get a little bit double benefit there, right? You don't pay tax on the gain, and you get the deduction at fair market value.
We were advised to do that, and we set up a little scholarship at USF with that very thing. The other thing we'll talk about charitable deductions while it's on my mind. My wife is the CEO of the United Way locally.
Yeah.
And so Bank of Tampa is part of the United Way campaign.
Certainly.
So when I first started at the bank 11 years ago, I signed up immediately. And so after she had gotten the job, she comes home one day. This is probably a few months into her job, and she's like, "Do you donate to United Way?" And I'm like, "I was very proud."
Yeah.
I'm like,
of course.
Yes, I do, honey. Yes, I do. And she's like, "Stop that! We just increased our donation level." I'm like, "Oh." She's like, "We're double dipping. I didn't know you were donating too." So we fixed that. But but took advantage of the charitable donation.
I thought you were going to tell me she looked up your donation level and was very disappointed. So you need to get that higher.
She probably would have been, but she was compensating for me.
Okay, got it.
So we joked about the IRS being about everybody's favorite government organization, but there was the threat of 87,000 new agents that thankfully went away. But it is something that scares everybody. So, I mean, to avoid an audit, what would you recommend?
Well, I'll say one thing first. Adding agents from our perspective, from the practitioner perspective, was not all bad.
Okay.
Adding auditors is perceived as being bad, and I understand that. But they had been, due to funding cuts for years, kind of woefully underemployed in the taxpayer services area. So we were calling the IRS on taxpayers' behalf, and either couldn't get through or sitting on hold for 2, 3, 4 hours. Right. So that's just not. You can't operate a business that way.
No.
A taxpayer.
So agents good, yes. Auditors bad.
That's right.
Okay.
That's right. Yeah.
What was the mix? Was it 87 auditors or agents?
They never released that.
They didn't.
Yeah, that was
and that was problematic. From a personal standpoint, I mean, it never ended up in anything. But they had, I had gotten a letter that I filed late, which I clearly didn't. I had evidence that I didn't, and maybe it was like Pennsylvania or something.
Certainly.
So I sent the evidence to Pennsylvania. I got another note, and so somewhere else in like St. Louis or something. I sent it to 3 different places.
Yeah.
So you would get it back. So I would my package grew every time.
Right.
I probably didn't have to send it, but I was sending it out of like protest. So
yeah,
sure. Like,
sure.
$5 packages to St. Louis to be like, just get off my
Yeah,
back.
yeah.
And I never heard back and said, good job, you're good to go. But it just went away.
So we were finding that in states too. They were also
There's no agents.
The states were getting were under employed as well, right? After the pandemic and kind of cutbacks that have occurred, the notices keep coming. A lot of times they're just automated, right? So something in the computer system for the IRS or the state governments will trigger a notice, and then it's up to the taxpayer to defend that.
Mm-hmm.
And that's unfortunate because it takes time and energy to kind of prove you're right. As opposed to the taxing authorities having to kind of prove you're wrong, right?
The unfortunate thing there is that has also become a business because I think every time I'm listening to sports radio, that advertisement comes up. Issues dealing with the IRS,
right?
So it's a popular problem.
Well, I will say there are benefits if you have significant IRS assessments to ensuring that you are required to pay the full assessment. Mm-hmm. And by that, I mean there are programs where the IRS will allow you to look at your annual income and your kind of allowable life expenses, and they may modify what the assessment is. Their goal is not to bankrupt you, but to make sure they get just enough to not bankrupt you.
IRS, right?
Yes.
Take it right to the very edge, but we don't want you to go bankrupt.
Yeah.
Well, Shaun, anything else that our listeners should be aware of? Any other tax tips, and not tricks because we don't want the IRS involved, but anything else?
Yeah, just to as we said before, get ahead of your tax issues as you have things that come up that you think may even have a tax implication. So any kind of business transactions you're doing or personal transactions, get ahead, talk to your advisors up front, because planning in advance is way more effective than trying to plan in arrears. So that's kind of my number one suggestion to anyone. And whether it's me or someone else, talk to your tax advisor as things are happening, because we can't always fix what has happened.
Well, that's a perfect segue, because if you don't like your tax advisor or you need one, where can people find you, Shaun?
At CBIZ, we got an office right here in the Tampa Bay area. We have 160 or so folks locally doing tax, audit, risk advisory. You can find me online, certainly, and always happy to help.
Awesome. Well, Shaun, thanks for coming on Money Market. If you have a question or future show idea or would like to be a sponsor, you can message us at moneymarket@bankoftampa.com. You can find us on LinkedIn, X, Facebook, and on Instagram at Bank of Tampa and online at bankoftampa.com. Thanks for tuning in. Thanks for subscribing, and we'll see you around in the Money Market.